Hi and welcome back to Credit Conversations and our first conversation of 2026. I'm joined today by Chief Economist Mo Chaudhri and Director of Data Insights Dave Kerry. We're going to take a look back for commercial and consumer lending across last year and how it's looking for 2026. But before we do that, Mo, let's take a quick look back at the end of 2025. How were things looking for the economy?
Where we ended 2025 was quite different to where the year began. I think just putting that into some context is really going to be helpful as we look forward to 2026. So 2025, I am now starting to describe that as a year of two halves. The first half, there was a lot of uncertainty being driven by the budget of 2024, if we think back to then, and the changes around US trade policy. But what actually ended up happening was a real strong period of resilience. Incomes continued to grow. We saw people continue to be in jobs. And whilst no doubt there was some degradation in unemployment in certain sectors, the overall first 6 months for the UK economy saw the strongest growth across all of the G7 economies. So a really strong start to the year. However, as we moved into the second half of the year, and who can forget the uncertainty that was created around the budget of 2025, there were many policy implications that were leaked beforehand, and that seemed to create uncertainty for both businesses and consumers. And in the data, we started to see that come through. We started to see some retail sales, some people putting off their purchases, waiting for some kind of certainty when the budget was announced in November.
And how are businesses responding to that now they have a bit more certainty?
I'll go back to what were the key messages from the budget. And without doubt, one of the key messages that the Chancellor wanted to try and land was that increase in fiscal headroom. What does that mean for us as consumers, for businesses? Essentially, taxes went up. But when are those taxes going to bite? That's the real important. But you would have heard us talk about this before in terms of many have classed this budget as the spend now, tax later budget. And what that means is that those tax increases are really going to be backloaded. They're going to come through from 2027, 2028 onwards. So what we'll be looking for is, as minimum wages increased, as there's been an increase in some benefits, some households will benefit from that. From a business perspective, businesses really have to try and look at the opportunities. They have to really try and understand the risks out there, because both are going to coexist, both are going to be in equal measure. And what they really need to be able to do is pick the winners.
So I think that's a really good point to maybe bring Dave in on some of the commercial trends. So Mo mentioned, there's a bit of wage growth there, a bit of opportunity, and of course the increased taxation on through wage growth. What are you seeing from like a commercial opportunity and lending perspective? Who's doing well at the moment?
If we again look back onto 2025, what we've seen is some fantastic growth within the commercial sector for lending. So we've seen that across asset finance, we've seen that across loans, we've seen that across cards and budget in particular, as well as mortgages. But the underlying reasons and the underlying structure of that growth has actually been different depending on the market. So if we take, for example, the personal loans market, where we've seen the most significant growth within that sector has actually been the lower value end, the day-to-day borrowing that businesses need in order to be able to thrive and survive. Similarly, within the sort of budget area, we've seen this kind of innovation enter the market really, where we're seeing deferred payment credit, we're seeing buy now, pay later adjacent type behaviour really grow lending within that sector to again support this more day-to-day borrowing. And with that, though, we have seen things like the erosion of overdrafts and things like that, current account overdrafts, something that's been a quite significant mainstay within the sector for quite some time. And whilst that's been falling away, we've seen this kind of increase in this sort of growth sector of the budget lending. Mortgages is an interesting one in that the growth that we've really seen within that sector is a lot of consumers actually moving away from consumer buy-to-let borrowing to support their own buy-to-let portfolios into the commercial sector. So we've seen a significant reduction within consumer lending for buy-to-let properties into that commercial sector. And just touching back on the budget point there, that's interesting as well, because obviously we've seen that change in the budget. Now it's been announced that the rental income taxations are going to change. We're going to see a 2% increase there. And I think that's going to have a couple of impacts. I think it's going to potentially impact the confidence of consumers to want to go into that market and continue to adopt and thrive within that market. But also I'm expecting to see a translation of that increase onto consumers, onto renters, which is going to put pressure, likely near-term pressure as well, onto those arguably perhaps a little bit more exposed.
So if it's looking like those costs are potentially moving onto renters, then what does that mean for the consumer mortgage market?
I mean, again, Mo made the point earlier actually that in the run-up to the budget, actually, there was a lot of kind of rumours around what was going to be happening. There was rumours around stamp duty changes, and that did cause a degree of uncertainty and an impact on consumer confidence to borrow, particularly for those larger items, those bigger purchases like a mortgage, like a car. We saw a drop-off. We saw a drop-off actually in demand until beyond the budget, until that had actually stabilised. People knew exactly what it meant for them. I think the fact that some of the impacts to that kind of mortgage, arguably a more stable near prime population, the ones who are likely to bear some of the brunt of those later taxation changes, once they knew what they were and when they were likely to come in, that confidence returned. But it did take a few weeks. We saw a bit of a stutter in mortgage demand while consumers waited. Equally, people who were completing their journey, so not just in application demand, people actually halted part of their journey whilst they came out and then continued afterwards. But we have seen recovery. I think as we rounded out the end of the year, it did return to normal volumes. But I think that stutter will have an impact on the overall new lending volumes as we close out the year.
And how about in other product lines then?
Well, it was a fantastic year for most of the other sectors. So unsecured lending in particular, credit cards and personal loans saw massive growth throughout the entire year, really. So we finished up the year in double-digit growth, which was amazing. Buy now, pay later, very, very active, very, very popular market, continued its very, very strong growth, and it diversified its audience as well. So historically, something that was incredibly popular with the sort of younger and middle-aged groups continues to move through the demographics into the older groups, those who are now adopting digital journeys and taking advantage of these products. But some of the other interesting things we saw is that the impact of the introduction of these sort of arguably innovative products like buy now, pay later, deferred payment credit, is having an effect on the other sectors as well. So credit cards, adopting some of those features, allowing things like that, introducing more things like rewards and more sort of competitive products and solutions has drawn a younger audience back into that market, which has previously been waning somewhat. So yeah, we saw some really fantastic growth in each of those. And then finally, the retail finance sector. So that's had an interesting year as well, because overall we've seen strong growth within that sector as well. But it's a mix depending on the products in there. So revolving finance, again, that kind of more budget, more flexible method has seen very, very strong growth, up to about 30%. Whereas the more traditional sort of mail order, digital mail order now, but that saw weaker growth, about 1%. And part of that is actually the adjacent markets like the buy now, pay later market, attracting some of those customers away. We've seen an actual migration from that market into that sector using buy now, pay later to perhaps pay for the goods that they used to use those other capabilities for.
I think it's important to also just talk about the resilience that allowed lenders to come back into market. The amount of new products we were seeing, the innovations that we were seeing from the market, really having that confidence from overall, when we look back at 2025, continued income growth, we continue to see wages outstrip inflation. And as we go into 26, whilst inflation will be coming down or continue to come down, in certain sectors we'll see that same story, wage growth well above inflation. And so it's for our lenders to really continue to innovate, to see how they can bring to market those new innovative products to continue with some of the growth that we've seen in 26.
Yeah, and it's been fantastic actually. When we talk about the products coming into market, we've seen a sort of 10 to 25% increase in the number of products that consumers are eligible for, which is fantastic. We've seen a widening of availability of credit, particularly for some of the groups who have struggled historically. There's been a huge agenda this year on financial inclusion and enabling consumers to navigate the modern world using credit. We've seen across just the cards and loans market a 5% increase in eligibility overall, but with some significant increases in those lower income and sort of higher risk ends that's really enabled some consumers to make a difference in their lives, which has been great.
So what are the options available to consumers now if they're looking at, they want to be considered for more credit, but they might already have hit their limits potentially? Do they have a good way that they can help consolidate?
Oh yeah, definitely. Mo, your Refi proposition.
I mean, just bringing this back to that macro story for a moment. So many of our clients will already be familiar with our Refi proposition. It's our debt consolidation offering to the market. So being able to help borrowers consolidate their debts and actually give a guarantee to the lender that the extra borrowing will be used for paying off those debts. That's what our offering is. But taking that a step further, we estimate that over £15 billion of consumer spending can be unlocked if we were to see a wider adoption of that. And the analysis that we did recently, Dave, looking at how a borrower's risk actually evolves once they take one of these products, was really supportive of extra lending.
Yeah, it was. I mean, we saw that typically about a third of loan applications or more are for this kind of debt consolidation. And again, in an environment where there are increased pressures coming through, where there's more borrowing out there, they're going to want access to that market. And what we found is that when we looked at a set of consumers who took out that lending, and then we looked about 5 months later and said, well, what did you do? Only about half were paying off more than about 25% of their previous debt, which is good, but could be better. When we looked at what the impact of that was, those who were paying off more than 25% or not, the differentiation in risk emergence was huge. So what we found is that for customers who were paying off a significant amount, about a third of those customers went bad compared to the normal loans market overall. And when we saw the customers who didn't choose to pay off using that loan, it was about 3 times. So a lot more risk emergence. So this kind of solution, that ability to ensure the funds get to where they need to be, helps consumers. It also helps lenders to be able to offer products to arguably historically less eligible consumers because they weren't sure that this was going to have the right outcome, which is a win-win really. And we're both really excited about it actually. It's going to make a difference.
Great. So let's briefly have a quick think about 2026 and the year ahead. So if I could ask you both for one big thing that's going to happen this year, your predictions for the year, Mo.
I mean, I'll try and give you that in a phrase. And that phrase is giving credit where it's due. I think firstly, as an industry, we deserve a bit of credit. You look back at 2025, it was a really strong year. Nearly all lending markets ended up seeing growth, many double-digit growth. As we move into 2026, being able to continue that financial inclusion story, being able to actually widen eligibility, giving credit where it's due. And I think that's my biggest prediction. I think we're going to continue to see a widening of eligibility, being able to take credit products out to a wider audience. And that's what's going to fuel the growth.
And Dave, same question to you.
I think mine's really centers all around confidence. So confidence of consumers knowing that they are able to get the right credit at the right time for the right price from the right lender, which is a lot of things, but that's something historically that hasn't necessarily been available to as many people or as transparent as it is today, to be fair. I mean, through 2025, we've seen a lot of change, and a lot of that has been to the benefit of the consumer. More competition in market, prices coming down, eligibility growing and growing and growing so that consumers can really see what they can get when they come to the market for credit. And that growth and the innovation that's come through that sector, some of our partners working really hard with us to figure out how they can widen their lens to include more people and offer those people as well as compelling products as the people at the other end are getting. So that's, for me, that's the kind of confidence that consumers are going to need to want to continue to borrow.
So quick summary then, 2025, it's been, let's say, a bit up and down, a bit of instability there, but 2026, still some challenges ahead, but a number of opportunities there as well. And I think it's a good time now for lenders to look at their data, look at their insights, the tools that they're using, so that they can give credit with confidence.
Yeah.
Great. Well, thanks for joining me, guys. It's been a great conversation as always. And thank you all for joining us for Credit Conversations. We will see you next time.